This is Tom Aspray. I'm really excited about this weekend's video. As I discussed in my last contribution to Forbes, this is the only 7th buy signal since 2000 by this indicator. It's a pretty powerful signal. The advanced decline line, it's what it's based on. Of course, I teach extensively about the advanced decline analysis, and as was the case for most of these signals, my other advanced decline indicators confirmed this signal. This is what the chart looks like. New York Composite, the last signal here at the end of March. Prior to that, there was a signal on January 10th, 2019. That was after one of the worst quarters in decades, the last quarter of 2018. Many people thought, we were going to be in a recession. Just before this low, only 20% of the investors polled by AAII were bullish. It created a great opportunity. By early January, my things were flashing bullish signals, and new highs were likely by the middle of February. A little longer term look will show you that there was a signal in 2004, just after the market completed its correction from the dot-com lows, soaring into the highs in 2007, and then right after the low in March of 2009, there was another signal. Also at 2011 in October, when my advanced decline analysis said the selling was over and traders should be long, not short. So who was Marty Zweig? He was a very well-known stock newsletter writer in the 80s on Wall Street Week, and then became a money manager. This is a view from his little apartment at the top of the Hotel Pierre. When he bought it, it was the largest real estate transaction. I think it was $95 million in that year. You can see he had this whole top half of the building. Pretty nicely furnished, as you can see by a couple of these images. And I assume this was Marty's office. So if you're thinking about retiring the next 10, 15 years, or you're tired, now is the time to take advantage. So if you go to the Viper report, you click on this "Don't miss this chance to build your investing future." It'll take you to a description of the course, which includes 6 one-hour sessions with me one-on-one. And in those sessions, I'll take you through understanding and using the advanced decline analysis. You get over 6 hours of individual instruction. Each session is followed by a testing with me to be sure you're learning. If you're not, then you may have 7 sessions. It's normally $17.99, but it's currently being offered for $8.99 through PayPal. Once you've signed up, my office will contact you to set up a call, and we'll discuss the best approach for your training, and we'll try to do them over a 6-week period, and then there'll be follow-up access to me. So I hope you will take advantage of this unique opportunity to build your investing future. We do offer a money-back guarantee. If it doesn't work out for you, we just charge you a small processing fee, and then the rest will be refunded. I hope you enjoy this week's video. This is Tom Aspray with the Viper Report. In this weekend's video, I'm going to focus on the Zweig Breadth Thrust Indicator, developed by a gentleman by the name of Marty Zweig. Very interesting character who I used to follow over the years and never had the pleasure of meeting, but he developed a quite interesting indicator that doesn't give many signals, but it did last week. First of all, let's look at the market action last week. You can see that it was generally positive, led by a change for the utility average. Lower yields helped that sector, and but other than that, gold was up 1.3, like the S&P was up 1.3. Nasdaq 100 was a bit muted, only up 0.8%, and the Dow did pretty well. I'll show you a chart of the Dow AD line, and it's looking stronger than most. So for the year, finally, all the averages are back in positive territory, even the utilities. They've been negative last week. So pretty good showing so far for gold for the year, almost up 10%. Of course, the QQQs are still leading the way, up 19.4. The Zweig Breadth Thrust Indicator, often referred to as the ZBT, is based on the differential of advanced decline numbers, and Mr. Zweig felt that the rapid shift from fairly negative numbers to very positive numbers indicated increased flow of liquidity into the market and was therefore bullish. So, if you look at the formula, it's basically the advancing issues divided by the total issues, or the advancing issues plus the declining issues. The key here is that it needs to drop below 40% or 0.4 and then move above 0.61% or 61.5% within 10 days to generate a thrust signals. And there haven't been many of them. Before Marty passed away, there was only about 14 since 1945. So let's look at some charts. This slide is from a current advanced decline course, but you can see we had a breadth thrust on the 31st. We got down here to like 0.35 and then up above. And prior to that, there was a signal in January of 2019. Those of you remember this horrible slide in the last quarter of 2018. I think it was in the worst in decades. I know I had a lot of readers who I voiced my opinion to. The bull market was not over at that point, and fortunately many of them hung in. We're thankful. And then there was also a signal in 2015. This is the few going back almost forever where the market made a subsequent new low. There were very strong signals both up here in December that the rally was over, and also of an important low here in February of 2016. I had a column called Is There Blood in the Street? Yes, in Forbes, and created a great, as you can see, a great buying opportunity. If you want to look a bit further, you can see in 2004 here there was a great signal that came in, and I think it was about in April or May, prior to that last couple of years in the bull market that topped out in 2007. Late March of 2009, right after the lows, another positive signal. 2011 is a really bullish setup on the AD lines on a daily basis, which has been the case for most of these instances in early October 4th, I believe it was. And in that case, the ZBT came a week or so after that. 2013, caught this little pull back before the surge into the 2015 highs, and then, as I mentioned, this one in October was before the lows, and then 2019, and then last week. What I find interesting is that, according to Zweig before, when he wrote about it, there was an average gain of 24.6%, lasted about 11 months. That's obviously quite impressive, but also, there were no signals for 25 years. But what I really find interesting is that the last few breadth thrust indicators signals have accompanied a situation similar to this. The end of 2018, everyone was kind of looking for a recession, worried about the Fed was going to force you into a recession. There was lots of concerns, and the majority of the Wall Street strategists were quite bearish. Lowest cash position since 2006, I believe. A number of those numbers were really skewed, as somewhat they are this time. So that creates an interesting environment. I don't think many would, if you surveyed, many would say this is a start of a new bull market, but you never say never, or you never say always in the stock market. So I'm keeping a positive approach. This will be featured more on this week's Forbes contribution, which should go up in a couple hours. Let's look at the rundown of some of the charts we normally discuss. So this is a weekly chart of the SPY. Shows you we kind of made a new high for the week, but then closed, down like 0.05%. Futures did better, as we'll talk about in a little bit. So S&P 80 line above its moving average, positive, still below this resistance in a breakout period. Stocks only, similar sort of scenario. It's in a clear uptrend after this surge here, at the start of the year. And NYSE All AD line, which is the same data, the thrust indicator, it's positive. And, certainly a week of very strong breadth would make all these look pretty good. A good week is consistent with the daily chart analysis here. We broke these downtrends. We've been looking for a pullback. Frankly, it went a little further in some of the ETFs than I thought it would, but still quite positive. So, if you look at this, you could still come back a little further, but, you get a positive day of advanced decline numbers early this week. It'll look pretty strong. Of course, we need to move above this last high to confirm the resumption of the uptrend. Moving averages are still rising. S&P rising the fastest. Stocks only less. And, NYSE about the same. The weekly AD line for the Diamond DIA looks surprisingly strong. You can see it's moved well above to new highs for the year, just barely below the all-time high, but not much. And it had a pretty good week. You can show the earlier graph, it was one of the strongest sectors. So does this mean a move back towards, Dow stocks? Well, the relative performance here is still negative. If we switch to the daily chart, of course, the daily AD line also looks really strong. Hasn't really had much of a pullback here at all, on the plus side. On the negative side, you can see there's a bunch of supply up in here. So it's going to have to battle to get through that. This high back here was 336.12, so we get above that. One good day would do that. That'd be a good sign. The daily relative performance is trying to bottom out here, but, it really, needs to see us, get above, these peaks back here from earlier in the year to suggest it was a new market leader. The weekly chart of the QQQs and the Nasdaq 180 line also still positive. It's sort of edging up here, still looking for this 335. Get much above that, we should get the bull's attention. 80 line is positive. We peaked out above this resistance here 2 weeks ago and then pulled back. So, a really big down week could drop it back below its moving average, and then it would be back in a range. Conversely, a good strong up week would show a bullish zigzag pattern here. I think that is still the favored scenario. If we go to the daily chart, it does suggest this is a pullback within the uptrend. You can see with the 21-week weighted moving average, it's still rising, and it was rising back in here after a similar pullback. So, it flattened out a little bit here. So we're kind of looking for the potential for this sort of move up at a minimum. That'd be like a couple of weeks of pretty good activity. Back then we went from 275 up to 310, so decent percentage move. The market was able to do some of its overbought status last week. You can see the percentage of QQQ stocks above the 10-day moving average went from 97 down to 55, I guess now. So it could still, 55 rather. It could still go further. So we just pulled back to the 20-day EMA, so that's pretty normal here. Also, the NYSE Advanced Minus Decline Oscillator, you can see it hit this plus 1300 level. It's now pulled back to minus 150 roughly is where it closed, I guess, or plus 21. My apologies. So it's relieved it. It could still see another zag down here, but that's typically what you want to get rid of that overbought. So, it was a sign that, was not really be good as last week started, a good time to be doing new buying. Lots of Fed speak this week, on Tuesday in particular, and then of course we get the could be dreaded, could be good CPI number. Given the PCE, I think it might be better than expected, and also we get the minutes of the Fed FOMC meeting, so that's usually pretty relevant. Producer price on Thursday, then retail sales, industrial production, and the mid-month reading for consumer sentiment. So plenty to keep the markets moving in the week ahead. As expected earlier in the week, I thought yields would drop more down this week, so you can see we made new correction lows here down on this support line here. MACDs are negative, but you can see the histogram has the potential here to form a divergence. No divergence, so if it makes another new low, starts to uptick here, the fact that the 20-day is still declining suggests that's not going to be an immediate move, but something to be aware of. The pullback in some of the strong sectors like the XLK, looks pretty mild. A little pickup in volume first part of the week, but still OBV is well above the breakout level here, so getting down closer to that new monthly pivot, which is at 145.41. Lastly, let's take a look at the futures chart. The daily futures chart still positive from this buy signal here on the 29th. Pullback here looks pretty normal. Still below this first target at 41.90. Volume is positive. Stochastics is negative at this point. Did reach the overbought levels here. You can see, back in January we had that similar pullback, then a push up. So after a surge the upside, my experience has been it takes a while before it rolls over. Volume still looks strong here. As noted on the message after the close on the 6th, the futures did flip back into positive territory with a confirmed buy signal, and had moved higher from that based on the jobs report. So 260 indicators are both positive, and the 5 EMA is at 41.31 with the slower 20-day at 41.23, so that confirmed this buy signal here. So you can see next week, is the first target, here is at around 41.51, which is also where the MR1 is. So down below here, 41.44, so second target at 41.69.18. That's all I have for today. As always, send me your questions at Tom@Viper Report. Something I'm not mentioning you're interested in, please let me know. Thank you for tuning in.